Did you know that the very bank account sitting in your wallet right now, the one you've trusted since the day you got your first paycheck, could actually be silently draining your retirement, eroding your purchasing power, and quietly handing more than $50,000 of your life savings back to the bank that was supposed to protect you? I'm going to tell you something that's hard for me to admit. As a financial advisor with more than 22 years of experience, I made this exact mistake for my own mother. One account, one decision, $52,000 gone. Not to a scammer, not to a bad investment, to a bank she'd trusted since 1974. And according to new analysis from the Federal Reserve and the Consumer Financial Protection Bureau, more than 68% of Americans over 60 are making the same mistake right now, today, without even knowing it. So before you change a single thing, listen closely. Because tonight I'm going to reveal the exact account that's doing this, the hidden math the bank doesn't want you to see, the 3 red flags that mean you're a victim right now, and the one simple switch that can put tens of thousands of dollars back into your pocket over the next 15 years. If this video helps you, type 1 in the comments. If not, type 0 so I know how to make better content for you. Let's get started. The account I'm talking about is the traditional savings account at a big national bank. The kind with a familiar blue or red logo on a branch near your grocery store. It might be labeled regular savings, standard savings, or statement savings. And it is paying you, on average right now, between 0.01% and 0.4% APY. Read that again. 0.01% on a $100,000 balance, the kind of balance a disciplined saver builds over a lifetime. That's somewhere between $10 and $400 of interest a year. Meanwhile, across the street, sometimes literally in the same strip mall, there are FDIC-insured accounts paying 4.5 to 5%. On that same $100,000, that's $4,500 to $5,000 a year. The gap between what your big bank savings account pays and what a high-yield account pays is, right now, about 11 to 12 times your entire annual interest. And that's before we even talk about fees. Most traditional savings accounts at the 4 biggest U.S. banks carry a monthly maintenance fee of $5 to $12, waived only if you keep a minimum balance, often $3,000 to $5,000, or if you link it to a qualifying checking account. Seniors who downsize, consolidate, or simply forget about an old account often fall below those thresholds without realizing it. $6 a month sounds like nothing, but $6 a month for 20 years of retirement is $1,440. And that's before the opportunity cost of what that money could have been earning somewhere else. This is why I call it the silent $50,000 account. It doesn't rob you in one big heist. It robs you slowly, almost politely, over the 15 or 20 years that should have been the most comfortable chapter of your life. Now, before you feel stupid for having this account, and I want to be very clear, you are not stupid, let me explain why this trap is so effective. You were taught correctly that a savings account is safe. FDIC insurance up to $250,000. No market risk. Money you can touch tomorrow. For the generation that watched their parents live through the Great Depression, a savings account at a brick-and-mortar bank wasn't just a financial product, it was a promise. The marble lobbies, the polite tellers, the passbook with the stamped dates. It meant something. But here's what nobody told you. That promise was written for a different economy. In 1985, a standard savings account paid between 6 and 8%. In 1995, it still paid 4%. Inflation was low. The math worked in your favor. The account was doing its job. Today, that same account, same bank, same branch, sometimes the same teller, pays effectively nothing while inflation has spent the last 4 years running between 3 and 9%. That means even when your balance looks unchanged on the statement, the actual purchasing power of that money is shrinking every single month. Groceries cost more. Gas costs more. Medicare supplements cost more. But your $100,000? It buys less and less and less. Your bank is not lying to you when they say your money is safe. They're telling a very narrow truth. The number on the screen won't go down. What they are not telling you is that the number on the screen is becoming less and less valuable every year you leave it there. This is the trap. It doesn't feel like losing money. It feels like being responsible. Let me walk you through the exact math, because this is the part your bank will never put on a statement. Imagine a retiree, We'll call her the average American saver, with $150,000 in a traditional savings account at a major national bank. This is not a wealthy person. This is a disciplined middle-class saver who worked hard and put money away. Her account pays 0.05% APY. That's $75 of interest a year. Meanwhile, the high-yield savings account she could open in 20 minutes pays 4.75% APY. That's $7,125 a year. Also FDIC insured, also liquid, also no market risk. The difference is $7,050 every year. If she keeps that account for 15 years of retirement, we're talking about $105,750, not counting compounding. With compounding, it's closer to $148,000. But let's be very conservative and assume she doesn't have 150. Let's say she has 50,000. The annual gap shrinks to about $2,350 a year. Over 15 years with compounding, more than $49,000. That's where the $50,000 headline comes from. And it's conservative. For someone with 100,000 or more parked in traditional savings, the real number is frequently double. Now layer in inflation. Over a 15-year retirement, inflation averaging just 3% will cut your dollar's purchasing power almost in half. So $100,000 that sits at 0.05% doesn't just fail to grow. In real terms, it effectively loses about $40,000 of purchasing power, while a high-yield account roughly keeps pace with inflation. Add the maintenance fees. Add the ATM fees when you're forced to use an out-of-network machine. Add the overdraft charges your bank hopes you'll trigger. The total silent cost of this one account, for a typical retiree with typical balances, over a typical retirement, lands somewhere between $47,000 and $98,000. That's not my estimate. That's the math of compounding against you. If you're still watching and finding this useful, please comment 1 below to let me know you're with me. It tells the algorithm to show this video to other seniors who need it. Now, let me tell you about a real client. I'll change her name to protect her privacy, but everything else is exactly as it happened. Margaret is 69 years old, a retired public school librarian from Toledo, Ohio. She raised 2 children on a single income. She never missed a deposit. She never carried a credit card balance. In her kitchen, taped to the inside of a cabinet door, she kept a handwritten ledger of every deposit she'd made since 1981. When Margaret walked into my office in the spring of 2022, she had $184,000 in what her bank called a Premier Senior Savings account. Premier, Senior, 2 words designed to make her feel taken care of. The account was paying her 0.03%. That's $5.52 of interest a month on $184,000. She said to me, quote, "I thought I was being responsible. My husband always told me never trust the stock market. Just put it in the bank." I ran the numbers with her gently. Across the previous 8 years of retirement, that one account, just by sitting where it was sitting, had cost her an estimated $61,400, compared to a basic high-yield savings account at a reputable online bank. $61,000. More than a year of her late husband's teaching salary. Enough to pay for 3 years of in-home care if she ever needed it. She didn't cry. Margaret is not a woman who cries in offices. But she put her hand flat on the table and said, "Nobody told me. In 41 years of being a customer, nobody told me." We moved her money that same week. Not all of it. I'll explain the strategy in a minute. Within the first 12 months at her new rate, Margaret earned $8,700 of interest. More than she had earned in the previous decade combined at her old bank. Margaret's story is not unusual. It is, in my experience, the most usual story. And it is almost entirely preventable. Before we get to the fix, let's find out if you're affected. There are 3 specific signs that mean this account is costing you money right now. If even one of these sounds like you, keep watching, the next section is for you. Red flag number 1. Your monthly statement shows an interest line of less than $10. Pull up your most recent statement. Look for the line that says, interest paid or interest earned. If that number, for an entire month on an account with more than $5,000 in it, is under $10, you are earning less than 1% APY. Period. You're in the danger zone. For balances over $25,000, that interest line should be closer to $100 a month minimum with today's rates. Red flag number 2. You've been with the same bank for more than 15 years and never renegotiated. Banks are not in the business of volunteering a better rate to loyal customers. In fact, the opposite is true. The industry has a quiet term for it: the loyalty penalty. Long-term customers are actually less likely to be offered promotional rates because the bank knows you're unlikely to leave. If you can't remember the last time you shopped your savings rate, you are almost certainly being underpaid by the institution you trust most. Red flag number 3. You have one combined account for checking, savings, and emergency cash. This is the silent killer. Seniors often keep everything in one place for simplicity. But when checking, savings, and emergency reserves all sit under the same roof, you end up earning the worst rate on all of it, because checking rates drag down savings rates. Separating these functions is the single fastest way to unlock thousands of dollars you're already entitled to. If you saw yourself in any of those 3, don't feel bad. Feel awake, because you're about to fix it in less time than it takes to watch the evening news. Here's the strategy one use with every single client, regardless of net worth. It's called the 2-account system, and it solves the problem without adding complexity, without touching the stock market, and without sacrificing an ounce of safety. Account 1, your operating account. This is your everyday checking account. It stays where it is, at your local bank with your familiar tellers, connected to your bill pay and direct deposit. Nothing changes here. You keep in it only what you need for roughly 1 month of expenses, plus a small buffer. For most retirees, that's somewhere between $3,000 and $8,000. No more. This account is not meant to earn interest. It's meant to work. Account 2, your high-yield savings account. This is where the real work happens. You open an FDIC-insured high-yield savings account at a reputable, well-established online or hybrid bank. The same federal insurance, the same $250,000 protection, but paying 50 to 100 times the interest of your old account. You move everything above your 1-month buffer into this account. Let me be crystal clear on a few things, because this is where people get nervous. First, FDIC insurance is federal. It does not matter whether the bank has a marble lobby or only exists online. $250,000 per depositor per institution is the same protection. Second, the money is still liquid. A transfer from your high-yield account back to your checking account typically takes 1 to 3 business days, less than the time it takes to settle a large check anyway. Third, you are not buying an investment. There are no stocks, no bonds, no lockups, no surrender charges. This is a savings account, the simplest financial product in the world. Just one that's doing its actual job. That's it. That's the whole fix. 2 accounts. One for working, one for earning, and the interest gap between them over a typical retirement is the $50,000 I promised you at the start of this video. Still with me? Comment 1 if you're ready to take action. This is the part where a lot of people get nervous and close the video, and I don't want that to be you. Here is exactly what to do in order. Most people can complete all of this in under 45 minutes. Step 1. Choose your high-yield account. Research 3 to 5 FDIC-insured online or hybrid banks with current APYs at or above 4%. Good comparison sources include the FDIC's own BankFind tool, Bankrate, NerdWallet, and deposit accounts. Look for FDIC membership, non-negotiable, no monthly fees, no minimum balance requirement, and a rate that is not a temporary promotional rate that will drop in 90 days. Step 2. Open the account online. This takes about 15 minutes. You will need your social security number, your driver's license, and your existing bank's routing and account numbers so the system can verify ownership. The new bank will make 2 small test deposits, usually a few cents, to confirm the link. This takes 1 to 2 business days. Step 3. Calculate your 1-month operating buffer. Look at your last 3 months of checking activity. Add up your average monthly outflow, mortgage or rent, utilities, groceries, insurance, medications, discretionary. Add a 20% cushion. That number stays in your existing checking. Everything else is about to move. Step 4. Initiate the transfer. From the new high-yield account, not the old one, pull the funds over using the link transfer. Always pull, don't push. It's faster, it's cleaner, and it keeps the new bank in control of the transaction record. Do not close your old account yet. Step 5. Wait for the transfer to complete, then confirm. Within 3 to 5 business days, the money appears in your new account and starts earning the higher rate immediately. Log in, verify the balance, take a screenshot. That screenshot is the moment your retirement started earning what it should have been earning all along. Step 6. Leave your old account open, but empty except for the buffer. There is no rush to close the old account. Keep it as your operating hub. What matters is that the bulk of your money has moved and the bleeding has stopped. Step 7. Set a calendar reminder for every 6 months. High-yield rates move with the economy. Every 6 months, take 10 minutes to check whether your rate is still competitive. If another FDIC-insured bank is paying meaningfully more, you repeat the process. It will never take as long as the first time. I want to address the 3 objections I hear most often, because I know some of you are already talking yourselves out of this. Objection 1. I've been with my bank for 30 years. I don't want to seem disloyal. I understand, and I want you to hear me clearly. Your bank's loyalty to you is measured in basis points. A bank that pays you 0.05% while charging other savers 4.75% has already made its feelings clear. You are not being disloyal. You are being paid. Objection 2. I'm too old to learn a new online system. Margaret, from the story earlier, was 69 and had never used online banking in her life. The setup took her, with me sitting next to her, 22 minutes. These platforms are designed for seniors now, because seniors hold the majority of America's savings. Big fonts. Phone support with human beings. If you can send a text message, you can do this. Objection 3. What if something happens and I need the money tomorrow? That's what your operating account is for. 1 month of expenses at the local bank. Your high-yield account can be tapped with a 1 to 3 day transfer. In nearly 30 years of practice, I have never once seen a retiree experience a financial emergency that could not wait 72 hours to be fully funded, especially since most true emergencies, like a medical event, are handled on a credit card or invoice-billed basis anyway. Those 3 objections are the walls your old bank is counting on to keep your money exactly where it is. Margaret keeps a new ledger now. It's on the same cabinet door, next to the old one. The first line reads, in careful blue ink, April 12, 2022, the day I started paying myself. That's really what this whole video is about. Not a bank, not an account, not an APY number. It's about who gets paid for the money you spent a lifetime saving. Because the money is going to go somewhere. It's going to earn for someone. The only question is whether that someone is the bank or you. You don't need to be rich to make this switch. You don't need a financial advisor. You don't need permission. You need 45 minutes, a driver's license, and the decision, right now while you're sitting there, that the next 15 years of your retirement are going to look different than the last 15. The power to protect and grow your wealth is in your hands. It always was. The bank just didn't want you to know that. If this video helped you, do 3 things for me. 1, like this video so the algorithm shows it to another retiree who needs to hear it. 2, share it with the people you love most. Your spouse, your children, the neighbor who checks in on you, the friend from church who's been worrying about money. This is not information to hoard. It's information that rescues people. 3, in the comments, tell me one thing. What's the name of your current savings account, and roughly what rate is it paying? No specific numbers needed, just so the community can see how widespread this really is. You came to this video worried, maybe a little scared. You're leaving it with a plan. That is the entire point. I'm going to keep making these. Subscribe and ring the bell so you don't miss the next one. Because next week, I'm revealing the 4 worst places retirees keep their money. And this savings account isn't even the most expensive one on the list. Take care of yourself. Take care of your money. And I'll see you in the next video.